I don't care about the money. I care about a successful transaction.
When we explain that first process, it is long. There's a lot that goes to it because this is not a overnight process.
Majority driver in a lot of the acquisitions we've seen lately is just talent.
Hello, Architect Nation, and welcome back. Today I have a question for you. Have you ever felt trapped in your firm, working insane hours, juggling projects, and wondering why after all these years, you still don't have any financial security or an exit plan the way you'd like? Perhaps you've asked yourself or wondered, how do some architecture firms sell for millions while others barely scrape by on the day-to-day? What's going on, and why are larger firms acquiring smaller firms like never before? And if you were to sell your firm, what's the real secret to building a firm that someone actually wants to buy? Well, on today's episode, you'll discover the hidden factors that determine the real value of your architectural practice. It's not what you think. Why some firms get acquired for top dollar while others struggle to find a buyer, even if they're profitable. And the surprising mistake that's quietly killing most small practices without their owners even realizing it. In today's episode, Business of Architecture principal and partner Rion Willard sits down with Bradford Jones, a former professional sports executive turned mergers and acquisitions specialist known for his sharp financial acumen. And as a father to six, he's no stranger to managing complexity. Joining him are Dylan Wren and Patrick Neal, all partners with the M&A firm Stone Mill Partners. As a reminder, today's episode is sponsored by Smart Practice. If you haven't already watched the free Firm Owner Masterclass on the Smart Practice method, what are you waiting for? Discover how to eliminate overwhelm, slay chaos in your practice so you can focus on architecture again. You don't need to reinvent the wheel. You don't have to do it the hard way. And as always, make sure you listen all the way to the end to catch important listener-only bonuses and special information. This episode is packed with insights that could change the way you think about your firm's future. So let's dive on in.
Patrick, Bradford, and Dylan, welcome to the Business of Architecture. How are you all?
Great. How are you, Ryan?
I'm very well, thank you. So you are all principals at Stone Mill, and very interesting as you guys are you do a lot of financial work with architectural firms or construction companies or companies in the AEC industry. And one thing that we'll be talking about a little bit today is mergers and acquisitions and the kind of transition plans that we often see in the valuations that are involved, and the whole world of consulting that actually kind of feeds into all of that. But let's just I'm going to check in with each of you, and perhaps you could each give us a little 30-second bio of your specific role within Stone Mill, and we'll start with Bradford.
Hey, I'm Brad Jones. I'm one of the principals here, and I work day to day with the buyers and sellers on both sides. I lead up some of our IT and help out with marketing, and I'm kind of the catch-all. So whatever's going on that day, jump in and help however I can.
Awesome. Dylan.
A very similar role to Brad, being a smaller firm. We're small but mighty, and we kind of catch everything for everybody. So principal also, day-to-day client relationships, marketing is one of my remits, and just ensuring that the processes are moving along. Both folks on the buy side, sell side have what they need, and everyone's going in the same direction happily.
Brilliant. And Patrick.
I'm the managing principal at Stone Mill Partners. I founded the firm. It's 13 years old. And so every day I manage the firm. I have a specialty of closing transactions.
Mm-hmm.
So that's something I really work through and work with the team on. Just kind of manage marketing, manage the deals, manage the culture of the firm, and kind of manage our pipeline and our team meetings that we have, and just ensure everything's running smoothly for our clients. Are number one here at Stone Mill.
Amazing. Brilliant. So it's a really interesting world, the kind of purchasing, acquiring of architecture firms specifically. And I've spoken to a few firms as they've gone through this process. How did you guys find that as a niche? And what does it tell you about the architecture industry that it's actually common enough that businesses are being purchased? Does it give us any information about the health of the industry as such?
So, well, I founded the firm, like I said before, 13 years ago. I was actually, I went to school to be a CPA and came out of school and was a management consultant. And originally, when I started working in management consulting, I was working in the food industry, believe it or not. And my brother was a headhunter that worked with architects and engineers. So it was pretty quick that I was beginning to work with more and more architects and engineers. And so I began to do so much, and that many years ago, there wasn't near as much that happened in the industry from an M&A standpoint. And so moved and founded Stonewall Partners, sold my partnership out of the CPA firm, and actually joined with a partner 13 years ago. And so as we've progressed along, my partner retired a couple years ago. He was much older than me, 20 plus years older than me. And then Brad and I have been friends for, I don't know, 10 or 12 years. And so finally snickered Brad into joining, and Dylan and I have been friends for 2 or 3 or 4 years now. And I've snickered Dylan into joining, just with a really good skill sets. They had a similar personality, a similar culture to the rest of us at Stone Mill. And so progressing to today in the industry, since 2020, there's been a lot of dramatic changes in the industry. Private equity has entered the marketplace just because we're such a fragmented industry prior to 2020. And now we're seeing a lot of consolidation. It's really driving the volume of mergers and acquisitions. For us, typically we would do 30 to 40 transactions a year. The last year was 70.
Wow.
So you kind of see the range of the movement in the industry, just because primarily there's a lot of, I call them the 40 to 50-year-olds that historically really didn't sell. Now they do, at the rate of maybe that probably makes up 20% of the marketplace, I would say, just because they want a better work-life balance. They have children in school, children in college, and they're working their 40 to 50 to 60-hour weeks and then having to do the back office stuff after that. So they just want a better balance. And then there's the talent war that's driving M&A, and then just the need to be competitive with the huge companies that are being created through the private equity platforms that now exist in the marketplace.
So that was interesting that you said that there's a lot of 40 to 50-year-old kind of business owners that perhaps would have stuck the course historically and who are now selling. Who else is buying and who else is selling? What does the market look like?
So on the sellers, you still have the traditional people that are 2 to 3 years away from retirement. So they want to sell, and we're going through the baby boomers have been hitting retirement and are continually coming up and hitting retirement. So that will continue on for, whatever many years are left in the baby boomer decade. The buyers, really what's driving a lot of buyers outside of private equity, the strategic buyers, is really the need for talent.
Yeah.
I mean, this industry, you have to have people to build. And if you can't find people, your revenue is not going to increase. And so with the firms that are, especially with multi-partners, ESOPs, multi-shareholders, they have to continually generate a normalized return on investment every year and normalized growth every year. And if you can't find people, you can't do that, right? And so the only way to get people these days is to acquire, because getting them through headhunters now is they're picking up the same people, are being shifted from this firm to that firm, and so you just can't get it anymore. And so now acquiring a firm, you can get a whole group of really senior level people that are used to working together as a team, and that fits culturally with your team. It's a win for everybody. And then after 2020, we've seen a lot of the concern of different project types. And then further to that in 2022, when interest rates increased so much, and people or firms that worked in the private markets felt, for the most part, to some degree, felt a downturn in their work. People are beginning to diversify into different sectors, different project types. And the quickest way of doing that is to acquire.
Right.
And so that's That's probably the main reasons that people are acquiring these days. And then the third reason is just stay competitive. Like I said before, a lot of the much larger firms are beginning to compete with smaller firms on smaller projects. And when they come to town and begin to compete on smaller projects, they have huge marketing budgets. They have just great talent in a lot of cases, and it's just very difficult for the smaller firms to compete on a regular basis with the really large firms. And so that's causing them to either sell or acquire to stay competitive in their marketplace.
Interesting.
Yeah,
Very
kind of Patrick, so layer on to Patrick's point about talent too. Uh, we're hearing a lot of folks coming to us and saying, I need to acquire firms. I have more work than I'm able to put through my system right now. So the work is there, and it really is just finding senior enough folks to put that work through. And that has been a majority driver in a lot of the acquisitions we've seen lately, is just talent.
This has been something that we've seen so much of, particularly since 2020, like the difficulty in hiring senior talent. And I guess there's lots of reasons for why there is this kind of void of senior talent. They've already been employed in certain practices, and there might be, and I know during 2008 it did cause a bit of an exodus in people changing the profession, or at least finding it difficult to get the right kind of build experience, and there has been a sort of a lot of movement in and out of the architecture industry. When you see a firm that approaches you who are making an acquisition based on, because they want to compete and they want to have talent, what is your role then? Do you find are you the ones that then kind of go off and find sort of suitable candidates for them, and kind of evaluate? Could you tell us a little bit about how that process works?
Yeah, we represent buyers in that manner. So a firm will come to us and engage with us to say, hey, here's our kind of wish list. Here's where we're looking to either diversify our skill sets, acquire talent, gain a geographical foothold. There's a lot of the Southeast is driving a lot of interest right now. So we have firms coming to us with that. We kind of take their wish list into mind, and then go out, and then we start seeing who matches properly, not just from that wish list, but that fit, focus, and culture. And then we begin reaching out to established contacts that we have, folks that we may have spoken to in the past that weren't quite ready to sell. We've got a large Rolodex, for lack of a better term, of folks that we then start engaging with, and finding that match for that acquisition.
I'll say, looking at that talent pool, one of the things that I think is so important right now too is having that second tier of leadership together. That's what we see in a lot of transactions right now, is if the second tier of leadership is not there and in a position to take over in a 3 to 5 to 7 year span or something, it makes it a whole lot harder to sell, but it also makes it a whole lot harder to intrigue buyers into coming in and looking.
Right. So actually, there's quite a big weakness if the main principal, that's it, he or she, they're there, and then underneath them a more inexperienced team, and as soon as that one person leaves, then we've basically got a bit of an issue.
Yeah, that's right. That's exactly right. And I would say our buyers and sellers both come to us because in these mergers and acquisitions, a lot of people just focus on the deal and getting it done. We focus on the culture. We're a group of family and friends. We're all related, our best friends, and so we have a really strong culture. And I think people across the industry know that. And so when we're bringing firms together, that's our primary focus. Once we go under an LOI, is a letter of intent, is how do we bring the firms together, so that we're a family? How do we make decisions on, and I say this all the time to people, it's like we're engaged right now and we're working towards a marriage. So we're going to live in the city, or we're going to live in the country, or we're going to have a white picket fence, those sorts of things. And Ryan, I can't just explain how much more successful firms are that get behind that and participate in bringing the firms together. And I get excited about it too, prior to closing, than those who don't. And people in the industry know that, and that just drives success. So that's another thing that we really focus on. It's not just something that we say to get an engagement. It's something that we really do.
I think that's really interesting, actually, because often in the architecture world, mergers and acquisition get a bit of a bad reputation, or there's a kind of caricature that it's a kind of aggressive business move where a bigger firm just comes in and gobbles up a smaller one, and there's a sort of an unfair narrative that's happening, and but it's really not like that. Every time I've seen it in kind of close up and in detail, that there's a tremendous amount of work that goes into how you just described it, the kind of cultural fit there. So how do you guys then ensure that you're going to have two? And basically, you're like Tinder for businesses, right? So you're making sure that there's at least some sort of chemistry that can happen, and then you set the businesses up. So what do you look for to kind of ensure that there might be this cultural fit between two organizations, and when might it not be a fit?
Well, I think I'm going to start developing a Tinder for Business app now for world.
No leadership team. Swipe right. So we go. Swipe left.
I think what we do first of all is because we're architects and engineers and we're M&A advisors, you have to start with an Excel spreadsheet, right? That's what you have to start with. So we do have a very detailed Excel spreadsheet that kind of goes through everything from a high level, things like what's the firm going to be called post-closing, because that matters, down to the small things like what American Express card are we going to use to order off supplies the first day after closing, and then everything in between, meaning what our employee benefits what are they going to look like? Are we doing time? How are we recording time? Because that matters. How are we going to get together after hours? Do we do Braves games? Do we do Pistons games? Whatever, wherever you live, those sorts of things. So we take there's 100 or so different things on the spreadsheet that we like to measure and make sure we're integrated with as a combined firm. We assign those to principals in the firms and set timelines. So there's about 90 days from the point of a letter of intent to closing. So we like to get everything started in those 90 days, and we try to finish as much as we can. Keeping in mind, you can't finish everything.
Mm-hmm.
And then post closing, we separate it by quarter for 1 year, because it generally takes a full year to have everybody completely integrated and running as one smooth entity at that point in time, generally. So what we do then is we run weekly calls. We can't obviously make anybody integrate. So we have weekly calls where the principals get together and we talk about where have we been last week and where are we going next week in terms of integrating. This week we covered this. Do we feel good about it? Next week, let's cover this. And we make sure the principals are talking, and as time goes on and we get closer to closing, we even like to get it down to where the employees of the firm being sold are meeting, working with, having conversation with their peers at the buy side firm.
Right.
So that way everybody's super excited about what's going to happen. And I know it seems almost ridiculous to say, but there's a lot of cases where people get to close and they really don't know what they're doing tomorrow. And so it just makes us really sad. And when we like for all of our closings to get to the table, we like to get to the table and we all know what we're doing tomorrow.
Mm-hmm.
How we're marketing. We have a combined proposal together. We're already experiencing synergy by working on different projects that we wouldn't have got as separate entities, things like that.
Going back to your earlier comment of how M&A seemed like an aggressive, rough thing that people were not wanting to jump into, a lot of that was those unknowns. And so, kind of one of our jobs is to make sure that those unknowns are known. And, we love using the phrase that Patrick said a minute ago, whose American Express card are we using to buy paper on Monday morning after the closing? Because if you don't know the answer to that, somebody along the way failed to make sure we had that in place. And so taking those unknowns out of, if you don't know the answer to something, you get uneasy. So if you have a whole group of employees who don't know the answer to things, it becomes a rough day in the office. So we want to make sure that those things are answered through this integration process, through this closing process, so that it is as smooth as it could be. If we want you to call us again, if you're looking to buy somebody else, the greatest thing you can do is call us again and say, hey, that last transaction was awesome. Let's do it again.
Yeah.
We're not a one-off company. We're not trying to just sell you this one and then take our check and run away. We want to we want to sell you a firm every year.
Mhm.
And we genuinely care for the people too. We spend 6 to 9 months deeply integrated in these folks' lives. So you develop a care and a relationship with them, and we want to make sure that they're taken care of going forward. We encourage creating the space, allowing kind of the staff to be able to ask questions openly to whomever they're being acquired by. It's okay to say what's in it for me, what's changing. Bringing all those things, like Brad said, just not having any open unknowns, giving people that air to bring that up and have that conversation, and encouraging it also.
Do you ever see it when it's not a fit, and perhaps you do something like an initial work, and you're like, yeah, you know what, this firm that you're buying up is like, they're all vegans, and you guys, your specialty is abattoirs. We need to slow this one down.
Yeah, so they're covered pretty quick. I mean, if somebody's drinking Nestle water and then everybody else is drinking Fiji, that's a problem. I'll be honest with you, and a lot of our clients would tell you this. We're terrible about telling our clients, whether buy side or sell side, you really should not sell to this group, and here's why. We're used to seeing so many transactions on the other side. Ryan, we're just at the point in our careers and helping people. This is a small industry where and obviously you've got to have revenue to make a company run and be able to continue doing what you're doing. But I don't care about the money. I care about a successful transaction. And I think that's shown through each and every time as we're working with our clients and making sure we handle everything responsibly, making sure our clients aren't making what we're seeing as a bad move. Ultimately, it's their decision, right at the end of the day. But we absolutely point that out from time to time.
Yeah, and to even build upon that, we're guidance and counsel. We are not the final decision makers, but to Patrick's point, it's we need revenue, but there's a lot of times we encourage that it's not just the highest paying offer that's the right offer. There's so many other factors in that I've seen it multiple times where we will recommend something that will generate us a lower fee, but we will sleep at night and we will speak to you again. And that's much more important to us.
Yep.
The long-term success is actually really kind of crucial here, as opposed to just getting something which is a flash in the pan.
That's right. Absolutely.
Yeah. This is for all of us, this is much more about the relationships.
From your side, and then from the buyer and the seller side, what does a successful transaction look like? And perhaps you can use like what an unsuccessful transaction looks like as a kind of a marker, so to draw the distinction.
Yeah. So we've got there's two buyers out there that we're on I think it's our 6th transaction with each one of them. One's in the Midwest. This group knows I love them. I love them a lot. And there's one in the Northeast that we're all really close to. They've never been a client of ours, but we've sold them firms, and they've acquired the 5 previous firms, and we're actually working on 6 transactions with each one of them right now. And they both have not lost a single person except for retirement in doing these transactions. I consider that a success. If we can roll everybody in, everybody's happy, we don't lose people, I think that's successful. I think the ones, as a contrast, the ones that are unsuccessful, or the buyer, seller, whoever we're representing comes in and just drastically makes changes. Nobody likes change. You've had a tremendous amount of change being acquired. Your employees are your largest asset. They've had no say in this transaction really at all. Now they potentially have different bosses. They're meeting different people. They're doing different things. Even though their benefits may be the same, they're not carrying a Humana card anymore. They're carrying a Blue Cross Blue Shield card, whatever it may be. Nobody likes change. And then those that just come in and want to change everything to this architecture firm way, this engineering company way, in such a quick manner, just always causes people to leave. And I just think when people leave, and you're going to have this person or that person leave for different reasons, life changes, things like that. But when you have 10% of the employee base or more leave, I think we did a bad job. I think somebody did a bad job. If we're aware of it, I make personal phone calls to the buyer and seller and find out what happened.
Mhm.
Did we at Stone Mill, did we miss something? Because that matters, because we don't want to do it again. We don't want to recommend this or that again. We want it to be successful.
Do you see it where the new owner, for example, will kind of not have told you all of their intentions, and then suddenly they bought the firm, and then they're sort of stripping it back out and kind of pulling it out of getting rid of different assets and doing an Elon Musk on Twitter sort of thing. Well, I won't go into whether that's good or bad. That's just a.
Yeah.
But it's an example of a drastic change, though.
Yeah. For us, we've seen it a time or two over the 13 years, but I would say, Ryan, as God is my witness, we've seen it a time or two. Just because as Dylan mentioned before, we're so invested in our clients. People say to us all the time, how in the world did you remember that my wife was a neurosurgeon or something? We'd say, I told you that 10 years ago. How do you, just because we get invested in our client, we do. And so I just can't express how much we really care about not making a mistake, because it's affecting their lives and their employees' lives and their family lives and that sort of stuff. And it just becomes a huge responsibility to us as individuals at Stone Mill. And, and so we've not had it happen that much.
And, kind of what you were describing, like selling it off for parts, essentially, as we go through our process of our meetings and because, we'll do 3 or 4 meetings before we even get to an LOI stage sometimes. If that's the intention, that usually is going to come out.
Right. So there's a bit of definitely due diligence and picking up on what people are looking to do. So we've spoken a little bit about here, kind of one firm acquiring another firm, kind of talent grab, or perhaps entry into a specific sector. What about succession planning? So actually buying from within. We see that happening more and more in the architecture field with from ESOPs then to new partners that are actually purchasing it from the retiring ownership. Do you guys see that a lot? And if you do, what are the sorts of pitfalls and successes of doing that well?
We do see it a good bit still. From my perspective, and people in the industry may see it differently, but from our perspective, I get a call at least once every couple weeks where the owner of the firm had planned on transitioning the stock to younger owners, and so they present that opportunity to the shareholders. That most of the time they're really giving the stock to the shareholders that are coming up, and people, these young leaders just don't want the responsibility. So they don't want the stock. And then further to that, which still blows my mind, and I just can't wrap my mind around, they leave the company and join another company. It's like there was a breakup and they leave. And I get more and more calls about that. And so I don't know if it's a generational thing. I don't know, but it's becoming more and more common. It's crazy. So, but we're seeing a consistent amount of firms transitioning. To me, I think the wrong way of approaching it is, hey, I'm selling my stock to a younger member of the firm. And so, hey, here's 100% of the stock, issue me a promissory note, pay me out over 10 years, whatever it ends up being. And I'm here if you need me. And that happens a lot. And I lose control. Right. And I think the ones that work out best, however the financial aspect of it works out, or the financial arrangement is, I think that the principals that are transitioning to the younger generation needs to maintain control, and the people that are buying need to buy minority percentages over the years. So that way it's like you're on training wheels as replacing the owner. Generally, we find it takes 2 or 3 people to replace the owner. The owner was an entrepreneur, and they have good marketing skills and good operation skills, and they have good project management skills. And trying to find that in one single person is difficult sometimes, most of the time. And so having a group of 2 or 3 is probably a good idea. And then, like I said, putting them on training wheels. So you're just kind of you're letting them mirror you and for 3 or 4 years, and then you're bowling together with the bumpers out. So that way, if they make a mistake, you're there to set them on the right path. And then further to that, you're just there if they, if they need you at that point in time for the last 3 or 4 years of the transition.
Mm-hmm.
Like
It's
Patrick said, it seems like it's in more of a baby step world now, where we've got to start slow and start building them up, because if we put too much on you at once, it stresses you out, and then you're like, I can't handle this anymore. I need to go find something else to do.
Mhm.
So, and even if it's not an internal transition, if it's an external transition, even getting prepared to sell well before you sell is so important too. So I think it's just having all that preparation in place, whether it's the second tier or it's selling to the market or whatever it is. You can never be over prepared.
Mhm. And what does preparation look like? Because this is interesting. I mean, that exact scenario that you've just described, I've seen this as well, where young leaders of the firm, they're kind of basically given the stock, and then they've got like a long-term buyout plan or delayed compensation sort of plan, and they had no idea what it meant to be a business owner, and they're kind of in shock that they have to go and win work and all these other, and they've got no interest in the balance sheet or profit and loss. They just wanted to do architecture, and it's really sort of extraordinary. Or on the other side of that, sometimes we've seen young leaders of a firm go, "What the hell have I just bought? This like where is the profit? Where like what's going on? Like where's where's all the money happening?" And so it's can be quite a surprise, and then obviously like a divorce. So what does good preparation look like?
Yeah, on an internal transition, I think good preparation is financial responsibility classes. I think that's number one. This the firms that have done internal transitions well, they do that on a regular basis. And I know that seems basic, but I think that's where you start, right? I think it's okay, and it should be okay for your leadership to understand the financials and understand where you are, and your KPIs, your key performance indicators, and what makes this machine roll, right? What is the utilization rate? All these things are important to run an architecture firm, and making sure they understand that and understand the profitability and understand that if we don't put out 15 proposals this month, our revenue is going to drop. If we put out 20, our revenue is going to increase. Basic things like that. So I think that's the best place to start. And then the really good firms that have transitioned, and I say, what I mean by good is those that are in their second, third, fourth generations of ownership have really invested into their leadership, their up and coming leadership with classes on leadership. Right?
Mhm.
What does it mean to be a leader? What does it mean to manage? Just because you have people under you don't mean you're doing a good job. But if you're going to be a future leader of a 100, 200 plus person firm and up, what does it mean to lead and lead responsibly? What does it mean to take criticism? What does it mean to do all the things that leaders must do to run successful firms? And so I think it's to start with, I think there's a lot of education
Mhm.
for some time period before they become stockholders, right? And then once they become stockholders, and then give them that responsibility from other leaders, from regional managers or whatever, to just to kind of keep a check on them and make sure that they're handling it well.
Mhm. In the question of preparation is actually a very interesting one, and obviously a lot of firm owners at some point, they're going to want to be able to see what their options are for retirement and how best to kind of continue their legacy. And you mentioned at the beginning of the conversation, that not having that second tier of leadership in place is a big sort of, it devalues the organization very quickly. For firm owners who are wanting to maximize the kind of value of everything that they've built up over the years, what should they be focusing on? What does an attractive acquisition look like, either for internally or for externally? And then we can talk a little bit about private equity as well, because that's very interesting.
I think we can kind of each take one of these, right? Yeah, there's diversity in what you support, not being fully focused on one client and having a kind of robust and spread out portfolio. adds a lot of value to your firm and is more interesting to possible folks that are looking to acquire.
Yeah, I think having those people in place, and some of the acquisitions we see are to get those people in place that are coming in behind you. That whenever you're ready to walk out the door, you hand the keys. Here you go, and business doesn't stop. Business doesn't miss a beat. The customers know who they're talking to. They've already had that transition plan where they know Patrick is retiring, and here comes Pacey, and just whoever those people are. I think it's just, and especially for buyers, they don't want to have to start over. And a lot of times when you're having to find a new leader for that office or that branch or whatever it is, it's a big project to find a leader there. If that leader's already in place and it's a a low frustration level just to put them in place, it makes that buy way more attractive.
Mhm.
And buyers always ask us, the first questions we get on the phone is there a customer concentration? A client concentration, as Dylan mentioned. This is number one. Number two, is there a second tier? Because they want to get to the next question of why didn't they buy the firm? That's a great question. That means you're making headway here. And number three is the owner going to stick around. They want the owner to stick around 2 to 3 years, right? 2 years is okay. 3 years is phenomenal. That gets it done. That gets you full value. That's because this is a people business, right? And the principals at architecture firms have built strong relationships over the years,
Mhm.
and architecture firms aren't relationship driven. And if you change the names of firms quickly, if you change the relationship key points of the clients too quickly, it's dangerous, in terms of losing revenue. And so I'd say that is the key things, besides having your financials in order, right? Make sure you're profitable, meaning making sure you're running your business financially responsibly.
Having a strong backlog in place is very, adds a lot of value right there. People want to understand that, okay, I've looked at your past earning performance, your financials are in order. So how are we going to keep going forward? And having that backlog there is a key factor also.
Yep.
Do we see the equivalent of what property developers do, where they're looking for like a distressed seller and a property that really needs a good lick of paint and some major renovation? Do we see buyers doing that sort of thing where they can see like an undervalued architectural practice? And if so, what does it look like in the architectural world?
We do see that. We would call them like a diamond in the rough, right? And so well, we have those firms. We sold one in Pennsylvania last year that was just a hair under 5 million in revenue, and it was losing money every single year. And
Right.
the principals were phenomenal. They had great clients. They just couldn't handle the financial aspect of the business. And so there are definitely buyers looking for that, call it opportunity, if you will, to come in and are willing to take on the workload of not only springing that firm forward with the transition and continue to grow it and manage your relationships, but also kind of turning around, if you will, financially. So there are specific buyers out there that we know to call if there is a diamond in the rough in the marketplace.
Got it. So businesses as well that I presume that are carrying a lot of debt and haven't been able to kind of pay it off, and it would be easy for a buyer to be able to just sort of dispense with that, and then also get themselves a great asset in terms of new leadership, new team, portfolio clients. Perhaps we could talk a little bit about private equity, because this is quite an interesting thing, and there's also quite a big difference. So obviously you might have detected from my accent, I'm from the UK, and private equity in the UK and here in the US is quite a different thing. There tends to be a lot more private equity in the US, and there's a lot more money floating about. And I'm very interested actually that has become, like, architecture firms have become an interest in private equity. And I find that actually quite encouraging about the architecture industry as a whole, that the private sector, private equity, people are looking to invest in that way. What does it look like then for private equity to get involved? Is it that people are, a larger firm is using private equity, or are there venture capitalists that are coming in and looking to buy firms in specialist industries. Perhaps we could talk a little bit about that.
Yeah, so private equity for architecture has been unique. I know private equity for, and I know this is the Business of Architecture podcast, but I think I have to talk about private equity and acquiring engineering firms to start with, to kind of contrast the difference with architecture firms. Private equity groups, and we work with a lot of those, are very focused on numbers. They're very focused on growth. They're very focused. They're operationally focused. They're focused on KPIs and things like that to continue to grow the business successfully, responsibly.
Mhm.
And so it's really data driven, numbers driven. And that's just a home run for an engineer, right? I mean, they just love numbers. They're data driven, that sort of thing. Architects, as a general, not so much. Architects design beautiful buildings, and they're artistic and they're creative, and a lot of architects, there's a lot of really great architects that are super numbers focused, and there's a lot that aren't. And when you're joining a private equity firm, I think what's been the challenge initially, and not so much these days, even though private equity's really been acquiring architecture firms at a real pace since 22, so it's fairly new, is understanding the culture of an architecture firm, understanding how it works, understanding that you need numbers people to support the architects, not tell the architects what they're going to do and that sort of thing. So it's been, I think, a learning curve for the private equity firms, and there's several of them out there that understand it and are really, really great at it and have been super successful at it. And there's a lot of them that are kind of flipping over from the engineering world to the architecture world, and it's been a little rough for them for that reason. For some reason, everybody thinks architecture and engineering firms are the same, but they're not at all the same. And so since it's fairly new, they're acquiring firms to consolidate them to achieve growth, to achieve value in the marketplace. And there is the arbitrage of multiples that exist in our space. If you're a really small firm, your firm's worth in the 3 multiples. If you're a really large firm, you can get up to the 15, 16, 17, 18 multiple range with an architecture firm. And that creates a lot of value for all the shareholders in the private equity group as they grow and decide to sell to another private equity firm to maybe diversify a little differently, or become public, or whatever the case may be, or to go international. So it really creates a lot of opportunity for architects that they would have struggled to do on their own without that help and support to get there, I think.
What does it look like then when private equity gets involved in merging or purchasing? Does it just mean new owners, and then there's a lot of investment that's getting put back into the business, or do they buy multiple businesses and mix them together?
Yes, they buy a firm, usually a larger firm, and then usually the principals at the firm that they acquire initially are minority stockholders in the combined entity at that point in time. And then at that point, they generally assess where they are and where they want to go from here. How do we grow? And whether that be if you're an education-based firm and you're in 1 or 2 states, and with education-based architecture firms, you just can't grow in other states unless you have locations in that state as a general rule. So you look at some of the major markets that we have, Florida, California, Texas, things like that. And so the private equity firms will look to acquire there. And when they acquire, the people that they acquire, the owners there will generally do what's called rolled equity, maintain ownership in the overall entity at a minority percentage, and get, a sales price for the majority of their percentage, and become partners in the new firm as well. So as they begin to acquire firms in a strategic way and become quite large, they've met their objective of becoming an institutional powerhouse. For example, they're no longer worth a 5 multiple, they're worth a 15 multiple. They no longer have 4 principals, they have 15, 20, 30 principals. and they're getting much larger projects. They're more profitable in their projects because they have the private equity support there, and those guys are super smart. And then they have the other industry mega horses that they'll usually bring in these private equity groups to help kind of direct and help the firms operationally, strategically, to make sure they're growing the right way and they're tracking the right metrics, et cetera, to be as profitable and successful as they can be.
And, putting that in perspective, that conversation that Patrick just laid out there that we have, 6 months ago, I had that conversation maybe once or twice a week. Now I have it every day.
Wow. That's amazing.
Yeah, it is. They're becoming much more prevalent in this space.
Why do you think it's becoming more and more popular?
Well, so as Patrick was laying out there, right now you're a small mid-range company, you're a 3 to 5 multiple or something like that. As soon as private equity buys you, puts you in that platform and is able to increase that, your multiple just increase.
That's really amazing. That kind of multiple jump, like you just by the increase in revenue, is increasing the multiplier, the value of the company significantly. It's like kind of very quickly exponential.
Yep.
Yeah.
And that's for people who are interested in going that route. And for every 1 or 2 firms we have are interested in, there's 1 or 2 that are hesitant with it too.
Mhm.
So, if you're interested in keeping that equity and going on, there really is if you're with the right firm, if they know what they're doing and they're doing a good job, and we try and make sure that we vet everybody to make sure they are doing that.
Mhm.
There is a huge upside behind it because, like Patrick was saying, there's a platform company, and if they do K-12, but they want to expand education, then they're looking for a higher education firm. They buy that higher education firm, they bring it in. Everybody wants turf fields now, so they need a landscape architect because they're working in colleges and universities and high schools. And so now all of a sudden you're piecing all these pieces together and you're making this giant company that can do everything, technically in-house. And not only that, your revenue is increasing, hopefully your bottom line is increasing and your margin is increasing.
A good example, Ryan, is if you're one of the firms that the private equity acquires, you're the 4th firm, that they acquire, and you decided your firm was worth $5 million, and you decided to roll 10% in equity, 500,000 in equity, right? And you're worth a 4 multiple. And then in another 5 years, your $500,000 will be worth 3 times that amount, by them getting to a 12 multiple. And so now just kind of going for the ride, just kind of, you are working hard, and you're combining your firm with this group, and you're growing. You've grown substantially. I mean, just the rolled equity is now worth $1.5 million in 5 years. And it's just really difficult in today's work environment with today having the inability to go out and hire 20 people, which most firms could really use, or could really use additional resources, additional people.
Mhm.
It's just hard to get there on your own without the ability to acquire. And then architects, a lot of architects are afraid to acquire because of the risks, the inherent risks that they foresee, or that they feel are inherent risks to acquire. People are afraid to fail when you're spending your money. And then in this case, you have the private equity groups that are managing this risk, that are doing the deep dive diligences and things like that to assure we are making the right decisions when we're acquiring this firm.
Mhm.
So it kind of removes that risk, and it's no longer a 50-50 risk reward. It's probably a 20% risk, 80% reward type of situation.
That's very interesting as well. Is that actually, this is a very well kind of tried and tested sort of route for growth, and it's quite amazing actually what it can do for architecture practices. There's so many challenges with running a practice, and certainly with just going back to the hiring, the acquisition. But there's a reluctance there, perhaps from architects who they're not in the business. That it might appear like a very sort of business-minded move, but the bigger practices and private equity are kind of are helping that happen. When you meet smaller practices, how do you recommend just them getting comfortable with the idea of acquisition? Because it sounds like for smaller firms or kind of medium-sized firms to be doing it as a growth strategy really should be looked at with a lot of seriousness, because it can be could be very effective.
I think I'll start off. I think it all boils down to criteria, right? When we're talking to people, um, it's always about why are you thinking of doing this in the first place? Is it an exit strategy because you want to retire and spend more time with your grandchildren, or you want to travel, or is it because you want to grow and you just can't get there anymore? There's this in the architecture space, when you get to that 50-person range, you've got to begin to build a back office. And so as principals, you're making a lot of profit at 50 people, but now you got to take a step back. You've got to lose a substantial amount of profit over the next couple of years to bring in a CFO and human resources. That's hard for people to do. So that's a huge step. And that's the reason why 80% of firms are doing less than 5 million in revenue every year, just because they just don't want to get over that hump, if you will, and get to the next step. So sometimes it's that. And then sometimes it's we just want to grow and I'm afraid to take the risk, or I want to grow and I just can't get there fast enough. You have the serial entrepreneurs and it's just not happening fast enough. And so with that, depending on the criteria, we talk about strategic buyers, we talk about private equity buyers in the marketplace. And then generally, if they would be a good target for a private equity partner, we do like to present that to them. So we like to bring our clients options. We're telling you how it works with a strategic buyer. We're telling you how it works with a private equity buyer. This is how they can help you meet your criteria. And I want you to see for yourself. And you tell me how you feel about it. And sometimes it's great. And it makes it clear, for them. And generally it makes it clear for them which direction they want to go.
Great. Maybe we'll hear from Dylan and Brad on that as well.
We have seen a bit. I've seen some trepidation when private equity comes into the conversation. It has in the past had a bit of a negative connotation. You're just going to come in, strip it down, make it profitable, and flip it around. Not the case anymore. And working to educate our clients on that too, that private equity can be very advantageous for your goals. Even seen instances where private equity has come in as minority partners into a relationship, and it's just been a infusion of capital to allow that growth and that jettison that some of these entrepreneurs are looking for, that they can't get as quickly as they normally would or would like to.
I'll chime in with a shameless plug. Find someone to help guide you through the process.
Yes.
Because I think so many times if like you said earlier, it can be a tough process to get through, and a couple bad mistakes, you really could end up hurting yourself a whole lot more than you help yourself. And so I think that's where value, that we come in to help out with those things, is we've seen this. Like we did, Patrick said, we had 70 transactions last year. We've been averaging 40 to 60 a year for the last several years. There's not much, especially Patrick has been doing this for 4 years. There's not much he hasn't seen. So, I think there's a lot of value in making sure you're having somebody help guide you through that process and asking, and someone who can answer the questions that you need answered.
Yeah, a lot of these folks, you're only going to do it one time, and it's going to be a pivotal moment in that one time. So bring a couple of us along with you. Like we've seen it, we've done it, we're there to support, and we want to make sure that legacies and journeys are handled correctly.
Love it. I think that probably leads us on to a perfect place. If we've got people who are listening to this podcast and they're interested in either beginning the process of acquiring a company or selling their own, what's the best way for them to get in contact with yourselves?
You go first, Brett.
So the best way, and the first thing I'd recommend doing is visit our website at www.stonemillpartners.com. Check us out on there. You can see our listings. You can see kind of the presentation. You can get a little bit more of who we are. And then after that, just give us a call, schedule a meeting. We're always happy to sit down and do a video call and explain our process. One thing I tell everybody we meet, when we explain that first process, it is long. There's a lot that goes to it because this is not a overnight process. But the great thing about it is we explain it to you all along the way too. We continually are reminding you of, hey, here's how far we've come. Here's where we're going next.
And just to Brad's point, reach out to us. We're there by engaging with us right off the bat, by asking us some questions, you are not committing to anything, just seeing how we can support you and how we can bring our expertise to your journey. Please just reach out. We won't make you sign anything right away.
And then we worked with clients for I've talked to and continue to talk to people for years before they decide to sell. It's a big decision. I don't want you to call me and the first day sign up to sell. That's actually scary. You know, because there's a learning curve, there's a learning process. And so we're very transparent on our calls. Generally, when we're on there, we'll get onto the nitty gritty. We'll talk about value. We'll talk about all these things that people like to kick the can down the road on. We're not afraid to talk about it and just really set you up for success. And what we Dylan and I had a call earlier this year with a firm out in California, and we said, hey, look, you know, if you didn't sell and you waited another year, your value is going to be up just because the way their numbers are trending is going to be up so much, you know, and this guy was ready to go. And so we're just not selfish about it. And you can reach us at, you know, our email addresses as well. It's Brad at, Dylan at, Patrick at, stonewallpartners.com.
Love it. Brilliant. Well, an absolute privilege for me to be able to sit with all three of you in one go and pick your brains about this really fascinating world of mergers and acquisitions and what it looks like in architecture firms, and some really great insight there onto the nuances of how it happens on an architecture firm. So thank you very much for your time.
Ryan, personally, thank you for having me on. A pleasure getting to know you and chat with you and have the opportunity to, you know, present Stone Mill out to the world a little bit further.
Pleasure.
And that's a wrap. Attention firm owners, if you're working nights and weekends while still struggling to hit your financial goals and targets, well, you're probably not charging enough, period. The average small architectural practice is blindly undercharging by 30 to 40% on every single project, leaving what amounts to a small fortune on the table year after miserable year. The Smart Practice Revenue Capacity Planning tool exposes this hidden money leak in just 30 minutes, showing you exactly how much extra revenue you could be earning with your existing projects and team. Get this Smart Practice tool, courtesy of Business of Architecture, 100% free by going to businessafarchitecture.com/capacity. That's businessafarchitecture.com/capacity. And thank you to all of our recent listeners who left reviews for this podcast on iTunes. Your reviews help others find this podcast so that a rising tide raises all boats. To be acknowledged on this show, here's what you got to do. Open up the podcast app on your iPhone, search for Business of Architecture, and after clicking on the show, scroll all the way to the bottom to leave a review. Today's episode of the Business of Architecture show is sponsored by Smart Practice, the world's leading step-by-step solution for small architectural practice owners who want to structure their existing practice so the complexity of business doesn't get in the way of the architecture. Because you see, it likely isn't your architecture skills that hold you back, it's the business aspects of running a practice, managing projects and people, dealing with clients, contractors, and money. So, if you're ready to quit being a glorified administrator and get back to architecture again, go to smartpracticemethod.com to discover the proven, simple, and easy to implement Smart Practice method that is revolutionizing firm management for owners and teams. And as always, I want to thank you for joining us today and remind you that the views expressed on this show by our guests do not represent those of the host, and we make no representation, promise, guarantee, pledge, warranty, contract, bond, or commitment except to help you conquer the world. Carpe diem.